All right, everyone, buckle up because we're diving headfirst into the global financial markets today. And let me tell you, it's a wild ride out there.
Yeah, you could say that again.
It's March 12th, 2025, and, well, to put it mildly, things are a little shaky, a little turbulent, a bit like, trying to sail a paper boat in a hurricane.
I like that analogy.
So we're going to break it all down today using this report. We have Global Financial Market Overview, March 12th, 2025. Really get a grip on what's driving these markets and, more importantly, figure out what it all means for you.
Exactly. We're going to cut through the noise and see if we can spot some opportunities, maybe even dodge a few bullets along the way.
But first things first, U.S. stock futures are looking a little, well, let's just say they're not painting a pretty picture right now. Dow Jones down 1.14%, S&P 500 down 0.76%. Even the NASDAQ has taken it. Not as bad, but still.
Not a great way to start the day, that's for sure.
So what's the deal? What's got investors hitting the panic button? Is it just a blip, or should we be genuinely concerned?
Well, think of it this way. The market's kind of like a giant mood ring, right? Reflecting the overall confidence in the economy. And right now, that mood ring is definitely flashing anxious.
Anxious, yes.
Anxious, yeah. There's this underlying fear, this uncertainty about where things are headed, talk of trade wars, whispers of a potential global economic slowdown. It all adds up.
And speaking of trade wars, let's talk about the elephant in the room. Shall we change? Trump just dropped a 50% tariff on Canadian steel and aluminum.
Yeah, that's a big one.
Is this the first shot fired in a full-blown trade war? And if so, how bad could things actually get?
Well, it's definitely a major escalation. There's no doubt about that. And the problem with tariffs like these is they have this nasty habit of, spiraling out of control,
The domino effect.
One country throws up a barrier, then another retaliates. And before you know it, you've got a full-blown trade war on your hands. Supply chains get disrupted, costs for businesses and consumers skyrocket. And that uncertainty we talked about, yeah, it goes through the roof.
So not exactly a recipe for a stable market.
Not exactly.
But hey, amidst all this doom and gloom, there's a glimmer of hope coming from an unexpected place, actually Ukraine.
Oh, yeah.
They're talking ceasefire, and that's sent the euro soaring to a 5-month high, Bold. European markets are also rallying. So why the sudden burst of optimism?
Well, whenever you see geopolitical tensions easing even a little bit, the markets tend to breathe a sigh of relief. Risk perception goes down. Businesses are more likely to invest. Consumers feel more confident about spending.
So it's all about that sense of stability.
Exactly. And specifically with Ukraine, a ceasefire could mean a chance for economic recovery and rebuilding, which further boosts optimism.
Okay, so some positive news on that front. But now we've got central banks sending mixed signals. Europe slashing interest rates while the U.S. is holding steady. What's the logic behind these two very different approaches?
Well, it's a bit like two chefs trying to perfect the same dish using completely different techniques,
Okay, I like where you're going with this.
In Europe, they're trying to jumpstart economic growth by making it cheaper to borrow money, give the economy a little boost. The U.S., on the other hand, they're more worried about keeping inflation in check. They think lowering rates could overheat the economy and make things worse.
So it's all about finding that delicate balance, right?
Exactly, finding the right recipe for their specific economic conditions.
Makes sense. Now let's zoom over to Asia. Japan and Hong Kong are showing gains, but Australia seems to be struggling. Why the difference?
Well, Australia's economy is very tied to commodity exports, things like iron ore and coal. When the global economy slows down, demand for these commodities drops, and that hits Australia harder than some of its neighbors.
Interesting. So their fate is really tied to the global economic outlook.
You got it.
Now, remember a few weeks back when tech giants like Tesla, NVIDIA, and Palantir were having a bit of a rough time? Well, they seem to be bouncing back. Is this a sign that the tech sector is out of the woods?
Tech is a funny thing. It's incredibly sensitive to economic conditions. When growth slows down, tech feels it immediately. But these companies are also incredibly adaptable and innovative. So if the economic outlook brightens, they can turn on a dime and capitalize on new opportunities.
So they're like the canaries in the coal mine, but also incredibly resilient.
Exactly.
Speaking of industries facing headwinds, airlines are really feeling the pinch right now, issuing profit warnings left and right. Travel stocks are plummeting. What's the story there?
Well, remember that economic anxiety we talked about earlier when people start tightening their belts? Travel is often one of the first things to go. It's discretionary spending, and with rising fuel costs on top of everything else. Yeah, the travel industry's got a tough road ahead.
Makes you wonder if those summer vacation plans are still a good idea.
Yeah, you might want to wait and see how things shake out.
Now, here's another interesting development. Goldman Sachs just lowered their S&P 500 target.
Yeah.
And there's that ongoing probe into share buybacks. Should we be reading into this?
I think it's definitely worth paying attention to. Goldman Sachs lowering their target suggests that even the experts are getting more cautious about the U.S. economic outlook, and the scrutiny of share buybacks raises some important questions about corporate behavior. Are companies prioritizing short-term stock price gains over long-term investments and growth? That's the real concern.
So a lot to unpack there and a lot to think about.
Definitely.
So if we take a step back and look at the global financial landscape, it's a real mixed bag out there.
Right.
Trade wars, geopolitical tensions, economic uncertainties. It's a lot to digest.
It is, but remember, even in the midst of all this chaos, there are opportunities to be found.
That's the key takeaway, right?
Absolutely. The key is to stay informed, understand the forces at play, and then use that knowledge to make smart decisions for your own financial future.
And that's what we're all about here at the Deep Dive, arming you with the information you need to navigate these turbulent waters.
Exactly. So don't let the market roller coaster scare you off. Use it as an opportunity to learn, adapt, and maybe even come out ahead.
Now, here's a final thought for you to chew on as you go about your day. If all these global factors are impacting the market so much,
Yeah.
how can you, as an individual investor, identify those unique pockets of opportunity? And more importantly, how can you protect yourself from the downside risk? That's the million-dollar question, isn't it? And it's one that each of us needs to grapple with. And that's all the time we have for today. Thanks for tuning in to the Deep Dive, and we'll catch you next time.